A big hit for a tobacco giant, BAT's downgrade explained. This development has sent ripples through the financial community, raising questions about the future of one of the world's largest tobacco companies. British American Tobacco, or BAT, just got downgraded by RBC Capital Markets from sector perform to underperform, a major red flag for investors. This downgrade is significant because it reflects a lack of confidence in BAT's ability to meet market expectations. This signals that RBC expects BAT's stock to lag behind its peers, despite a strong run in 2025. Investors who have been bullish on BAT are now re-evaluating their positions. The downgrade challenges BAT's core strategy, its heavy bet on new, non-cigarette products. These products were supposed to be the future of the company, steering it away from traditional tobacco products. RBC's analysts believe BAT's hopes for big profits from these new categories are, in their words, seriously overblown. They argue that the market for these products is not as lucrative as BAT has projected. This isn't just a minor warning, it's a direct hit to BAT's transformation story. The company has invested heavily in these new categories, and a downgrade could undermine investor confidence. A downgrade from a major bank can quickly shift investor sentiment and drive down the stock price. This can lead to a vicious cycle where declining stock prices further erode investor confidence. RBC argues that the market's optimism about BAT's future is misplaced, celebrating a success that hasn't materialized in real profits. This skepticism could lead to a broader re-evaluation of BAT's market position. The key question: can BAT actually make money from its next-generation products? This is the crux of the issue, as these products are central to BAT's future growth strategy. The timing is crucial. This comes after BAT's stock nearly doubled the returns of rival Philip Morris International this year. Such a performance had bolstered investor confidence, making the downgrade even more impactful. That performance was built on the belief that BAT was successfully moving away from cigarettes. Investors were hopeful that BAT's new product lines would secure its future. Now, RBC's report forces investors to reconsider. Is BAT's future as bright as it claims, or is there a deeper weakness in its business model? This downgrade could be a turning point for the company. The market is watching closely. Investors and analysts alike are waiting to see how BAT will respond to this challenge and whether it can prove the skeptics wrong. Decoding new categories. BAT's bold bet on the future of nicotine consumption. As the world steadily moves away from traditional smoking, BAT is reinventing itself, aiming to stay ahead of the curve and remain relevant in a rapidly changing industry. BAT's new categories are its answer to a world with fewer smokers, covering all products beyond traditional cigarettes. These innovative offerings are designed to capture the next generation of consumers who are seeking alternatives to combustible tobacco. The three pillars, Vapour, e-cigarettes like Vuse, heated tobacco, Glow, and modern oral products, nicotine pouches like Velo, form the backbone of this strategy, each targeting a unique segment of the market. Vuse is a major player in the global vape market, offering a wide range of flavors and devices. Meanwhile, Glow competes in the heated tobacco space, aiming to deliver nicotine with fewer harmful chemicals than cigarettes, and appealing to smokers looking for a familiar ritual with reduced risk. Velo, BAT's modern oral brand, offers nicotine without tobacco, smoke, or vapor, growing fast as a discreet alternative. Its popularity is rising among young professionals and those seeking a more convenient, less conspicuous way to consume nicotine. These products are the foundation of BAT's plan for long-term growth, representing a shift from its legacy business to a future built on innovation and adaptation. BAT's public goal is ambitious: transition millions of smokers to these reduced-risk alternatives and generate significant revenue and profits from products that could one day eclipse cigarettes. Investors have largely bought into this vision, believing BAT could successfully pivot away from its legacy cigarette business and become a leader in next-generation nicotine. But RBC's critique strikes at the heart of this promise, raising tough questions about whether these new products can truly deliver the profits BAT projects. The bank argues that the profit potential of these new products is far less than BAT claims, pointing to rising competition, regulatory hurdles, and uncertain consumer adoption. The future of BAT hinges on whether these new categories can deliver real, sustainable profits and offset the inevitable decline in cigarette sales. If not, the company's transformation story may unravel, leaving BAT vulnerable in a market that's moving away from its core product. That's why this downgrade matters, not just for BAT but for the entire industry watching to see if the future really belongs to new categories. The profit puzzle. Why RBC is skeptical. RBC's main argument. BAT's profit expectations for new categories are unrealistic. Despite sales growth, these new products aren't generating meaningful profit. RBC points to structural weaknesses, problems built into the business model, not easily fixed. The most profitable segment, heated tobacco, is dominated by competitors, leaving BAT at a disadvantage. RBC estimates BAT's new categories unit was barely break-even in 2024, not the thriving business BAT claims. This lack of profitability threatens BAT's ambitious growth targets. If BAT keeps pushing low-margin products, overall profit margins will suffer. The bottom line: more sales, but not more profit. The rivalry with Philip Morris International. A tale of two strategies that has come to define the future of the tobacco industry. BAT's biggest challenge? Competing head-to-head with Philip Morris International (PMI), especially in the rapidly growing market for smoke-free products, where innovation and scale are everything. PMI's IQOS dominates the heated tobacco category, holding a massive 72% market share and setting the benchmark for the entire industry. BAT's Glow, by comparison, is only about 10% the size of IQOS, a huge gap in the most profitable segment and one that's proving difficult to close. PMI's smoke-free division boasts operating margins around 28%, a level of profitability that BAT's new categories division can only dream of, as it currently barely breaks even. This highlights a structural weakness. BAT is a leader in low-margin vapor, but remains a minor player in the high-margin heated tobacco space, where the real money is being made. Vuse is strong in vapor, and BAT has built impressive scale, but the economics of that market are far less attractive, with lower margins and tougher competition. For investors, the contrast is clear. PMI has a high-margin winner in IQOS, while BAT has scale, but not the profits to match. RBC's concern is that BAT's path to profitability will be much longer and tougher than PMI's, requiring more investment and patience from shareholders. The strategic gap between the two companies is widening, as PMI pulls further ahead in the most lucrative categories. BAT's focus on vapor may not deliver the returns investors expect, especially as regulatory and competitive pressures mount. The market is rewarding PMI's strategy, not BAT's, as seen in their respective stock performances and analyst upgrades. That's the heart of the downgrade, a fundamental difference in strategy, execution, and ultimately in investor confidence. Vuse is a global leader in vapor, but there's a catch. The vapor market is highly fragmented, with countless brands fighting for the same customers. Low barriers to entry mean new competitors can pop up overnight, keeping prices and profits low. Unlike the regulated, consolidated cigarette market, vapor is chaotic and fiercely competitive. The result? Price wars and razor-thin margins. Even as BAT sells more Vuse products, the profit per unit is tiny. Scale hasn't translated into strong earnings. RBC doubts BAT can ever achieve high margins in vapor. BAT is running hard just to stand still. That's a key reason for RBC's pessimism. RBC's report digs into BAT's profitability, and the numbers tell a different story. On paper, BAT's new categories unit shows a 17% profit margin, but this figure is misleading. It includes profits from BAT's traditional oral tobacco business, a mature and highly profitable segment. Strip out the legacy oral business, and the profit margin for vapor and heated tobacco drops to nearly zero. The supposed engine of future growth isn't making money. BAT is spending heavily to build Vuse and Glow, but not seeing a return. The reported margin is propped up by old products, not new innovation. RBC's downgrade exposes this flaw in BAT's growth story. The transformation isn't delivering real profits yet. RBC's outlook for BAT is bleak. The analysts predict BAT's profit margins will steadily decline, not grow over the next 15 years. As BAT sells more low-margin vapor and heated tobacco and fewer high-margin cigarettes, overall profitability will erode. Even if revenue rises, profits may not follow. This challenges the core investment case for BAT's stable margins and reliable dividends. If margins keep shrinking, the stock loses its appeal. RBC warns that BAT's current strategy could destroy shareholder value over time. The company's financial foundation is at risk. Investors should take this warning seriously. Alongside the downgrade, RBC raised its price target for BAT to £34. But don't be fooled. The new target is still far below BAT's current share price of £41.56. RBC expects the stock to fall by over 18% in the next year. The reason for the higher target? Lower expected spending on factories and equipment, not improved business prospects. RBC's underperform rating is a clear warning. Holding BAT stock now could mean losses ahead. They also outline a downside scenario. If things go worse, the stock could drop to £27. Even the upside scenario at £45 is less likely in their view. The main message: the risks outweigh the rewards. For investors, this is a major red flag. The market is being told to brace for a fall. RBC's final verdict is blunt. BAT's transformation story doesn't match reality. The company's vision of a smoke-free future has driven excitement and stock gains, but the profits aren't there. RBC's analysis shows that once you remove the legacy oral tobacco business, the new products aren't delivering. Investors have rewarded sales growth without checking if it's profitable. The success of PMI's IQOS proves profits are possible, but BAT's strategy isn't working yet. The key lesson? Don't buy the hype without seeing the profits. BAT's leadership in low-margin vapor isn't enough. The downgrade forces investors to rethink BAT's future as a safe, reliable stock. The gap between promise and performance is wide, and closing it will be BAT's biggest challenge. The market is watching to see if BAT can deliver real results.